Hello and welcome to Options in Plain English Advanced Edition. Today we're going to talk about options portfolio management. Up to this point, we've talked about individual options and strategies, their P&L, their behavior, and how to manage them. Today we'll take it a step further and look at a portfolio made up of individual options positions. Managing a portfolio requires a different set of skills compared to managing individual positions. There needs to be a portfolio objective and then a set of guidelines that will help you achieve your objective by using options and option strategies. In this lesson, we'll go over the most important aspects related to the creation, monitoring, and management of a typical options portfolio. We'll touch on the most relevant metrics and guidelines that will help you with the design of a set of best practice mechanics aimed at maintaining a consistently profitable options portfolio. These will include capital usage, maximum risk per trade, roles and adjustments, beta weighted delta, portfolio theta, and correlation, among others. Transitioning from individual option trades to a portfolio-based approach will give you the consistency and professional methodology that most fund managers and institutional investors apply when managing money. It'll also be a way for you to see option trading as a more viable and stable source of income while relying on battle-tested portfolio management strategies to make it happen. We're going to start by talking about a portfolio. A portfolio is a collection of financial assets under an account, and portfolio management is how to manage all those positions to meet a financial objective. If you want to think about an options portfolio, you would think about something like this. It's a collection of option strategies, option positions, option trades that you have under your account. Now, under your account, you might have several portfolios. For example, you can have an income portfolio, you can have a growth portfolio, etc. The main properties of a portfolio is that all those positions under a certain portfolio work towards a single objective. So they have a particular goal when taken together. Okay. In this case, what we're going to do is we're going to look at how to manage an options portfolio without focusing too much on the individual positions, but just looking at a portfolio as a whole and how it can help us achieve whatever objective we want from our portfolio. To do this, we're going to take a look at capital usage. We're going to look at defined and undefined risk split. We're going to look at maximum risk per trade. We're going to look at trade management, roles and adjustments, beta weighted delta, portfolio theta, beta weighted Vega, extrinsic value, and correlation. Each one of these different aspects we're going to be analyzing, and we're going to see how they come into play when designing our portfolio and when managing our portfolio. We're going to start by looking at capital usage. Capital usage refers to what percentage of your net liquidating value you're going to use for trades. So basically, for your portfolio, you've allocated a certain amount of money. What percentage of that money are you actually going to be putting to work in actual trades? Since options are inherently leveraged instruments, it is suggested that you don't use all your funds in trades, especially in option trades. Why? Because what you want to do is you want to use a certain percentage and then leave some cash to be able to manage positions in case you need to, or to put money to work when market conditions are very favorable to you. So what we would suggest when you start designing your portfolio, and you have to start by determining which percentage you're going to use, okay? And we suggest that you use anywhere from 20 to 50% of your whole portfolio in actual trades. You would need to determine what good market or favorable market conditions are and determine whether a certain market or a certain environment is conducive to your trades or to your trading style. So if the conditions are really favorable, then you're going to lean towards the higher end of the range. And if they're not, then you have to stay on the lower end of the range. What you want to do is you want to have 20% of your money in trades when the conditions are not favorable, and leaving 80% in cash. Why? So that when the conditions improve, you can take that money, some of that money, and then just take it and put it into the market and open some additional trades. Now, when you hit your 50% limit, then what you would do is you would just manage those positions. Maybe you can go a little bit over it, over 50%, maybe push it up to 60% or something like that. But the nature of options positions, especially if you're a premium seller, is that sometimes, and especially if you use undefined risk trades, they might grow, they might require a higher BPR, a higher buying power reduction. Because of this, you have to leave some cash so that you're able to weather whatever storm is thrown at you. So whatever situation you find yourself in, you're going to be able to work and to work with it and to actually make money off of it. Okay, so our suggested guideline is that you use from anywhere from 20 to 50% of your capital in trades. So what are favorable conditions? What are unfavorable conditions? So for example, in our case, we try to always focus on premium selling. So what we need is a high level of implied volatility is very conducive to our trades. If the overall market has a very low level of implied volatility, then what we want to do is we want to stay in the lower end of the range. We're going to deploy maybe 25 to 30% of our cash in trades and leave the some dry powder so that when the market gets better, we can take some of that cash, put it into the market, and we can take advantage of those conditions at that point. By the same token, we don't want to be completely out of the market because we need to put our money to work. So this is how you would determine how much or what percentage of your capital to use for trades. The second point we're going to talk about today is the defined and undefined risk split. So defined risk trades require less capital or buying power reduction, but have lower probability of profit and are less manageable. What I mean by less manageable is if you have a defined risk trade, for example, a vertical spread, and you want to adjust or roll that position, you need, if you want to roll for a credit, you need the price to be at a certain point such that your by the time you try to do the roll, you can do it for a credit. You are not going to be able to in every position, which is different than if you use undefined risk trades. Also, since you're going to have to be moving more legs, so for example, for a vertical spread, you need to move 2 legs, whereas for a naked option, you just adjust or roll the that option itself. Because of this, it has more friction, it has more slippage, and the more transaction costs on top of the actual inherently nature of rolling for spreads, which is that you can't always do it for a credit. Undefined risk trades require more capital, so a higher BPR, have higher probability of profit because you don't have the long leg taking some credit from your position, and are more manageable because of the same thing we were mentioning. It's easier to move 1 leg as opposed to 2, or 2 as opposed to 4 if we're talking about a strangle, comparing it to an iron condor, for example. Our suggested guideline, because the undefined risk trades require a lot more capital, even though they might not be necessarily, it's not directly proportional. The risk or the BPR is not directly proportional to actual observed risk, meaning that just because a trade requires you to put down $10,000, for example, it doesn't mean that you're going to let your loss get to $10,000. It's much less than that. Because of this, taking this into account, we suggest around a 25-75 defined undefined risk split. So we want to allocate a lot more capital to the undefined trades because they require more capital, not because we think they're better or anything like that. We just need more capital to put them on and to manage them. But in return, we get a higher probability of profit and more manageability. Because of this, we suggest a 25-75 split between defined and undefined. Now, this 25-75 is not a percentage of your whole account or of your whole portfolio. It's a percentage of the money that you allocated to trades. So it's not, so this 25-75 would be applied to the 20% that we have here, not to the 100%, only to the 20% or to the 50% here. It's just how you're going to split the trades that you put on. So you would have something like this: 25% for defined and 75% for undefined risk trades. Undefined risk trades are short options, triangles, straddles, ratio spreads. Those are examples. And there's many more, of course. Defined risk are long options, vertical spreads, calendars, and arm condors. So you can see the difference between undefined and defined. Okay, so defined, your BPR is never going to change, is very limited, and you either make money or lose money, but those positions don't grow with time. The undefined ones have better probabilities of profit, but at the same time, their BPR is higher, and also the BPR is dynamic. So if the position moves against you, then the position is going to require more VPR, higher VPR, which means that margin or BPR is dynamic. Now that we know how much money we're going to allocate to trades and how much of that money is going to be allocated to defined and undefined risk trades, what about maximum risk per trade? This is the percentage of your net lick to use for every trade. So out of your whole capital, not the capital that you allocated to trades or the capital that you allocated to defined or undefined trades, but rather considering your whole capital, all your funds. This is the what percentage of your whole capital you're going to use for every trade. Now, the suggestion here is to use in the trades that you have making up your portfolio, to use non-correlated underlyings and to diversify in products, in strategy, and time to expiration. So not only is it better for you to not trade the one big position, but rather trade many smaller positions, but those positions should be diversified in terms of not being the same one, so non-correlated underlyings, and also make sure that they're not correlated. So don't put on a short put in Apple and a long call in Microsoft, because those are essentially the same position. They're going to move together. So you might as well just put one big position for those two. What you want to do is you want to make them non-correlated. You want to have a tech company and a mining company. You want to have an ETF that specializes in European companies, and also you want to have an ETF that's short bonds, something like that. So underlyings that are not correlated, and also you diversify by strategy, so such that if your strategies are banking on an increase in implied volatility, you also have some that make money when implied volatility goes down. So you want to have always two sides of the coin, such that when those profits start showing up in your account, you can take them off. And that way, you're always going to have a healthy portfolio. The suggested guideline here is to allocate 1 to 2% of your whole portfolio 2 defined risk trades and up to 3 to 5% in undefined risk trades. Notice how we're allocating more money to the undefined risk trades just because of their nature. So this 1 to 2% and this 3 to 5%, maybe they're going to bring in, if you're talking about premium selling, maybe they're going to bring in the same money, the same credit, but because of the requirements for buying power reduction, you should allocate a little bit more for undefined risk trades as opposed to defined risk trades. Now, a defined risk trade could be a long debit spread, for example, or a long call if you trade that way, or a long strangle, a long straddle, anything where you can't lose indefinitely or in an unlimited way. That's what would be a defined risk trade. Okay, so those ones you should keep a very low percentage of your whole portfolio. And by the way, this is the maximum loss that you can sustain for defined risk trades. And in the case of undefined risk trades, is the BPR that position is using. Trade management, you need to know how to manage every individual trade. So if you have a portfolio and you have, let's say, 10 trades in that portfolio, you have to manage every individual trade. So you have to have a set of mechanics that deal with when you're going to be taking positions off. You have to define your profit target, when to adjust, when to roll, when to close. So you need to know what you're going to do at every different time and when a different set of circumstances happen to your positions. So it's very difficult to do this on an ad hoc basis. So basically defining it on the go. You have to define it prior to this. And this is a very important part of designing and implementing a trading plan. So trade management is an important part of your trading plan. So that you're not just making decisions when you depending on how you feel that day. You have to have clearly defined targets that you need to hit, or actions that you're going to take depending on how the underlying prices move, implied volatility, etc. Basically based on your P&L and also based on time to expiration as well. So we have some suggested guidelines, but you have to define your own. This is something that we use in our trading. So for premium selling, for example, we have a profit target of 50% of max profit for out of the money strategies. We have a profit target of 25% of max profit for at the money strategy. So for example, out of the money, if we sell a strangle, that would be an out of the money strategy. We take it off at 50%. If we sell a straddle, we would take it off at 25% because it's much more credit up front. We would use a 10% of the debit for a calendar spread, for example. This is based on your knowledge of every strategy, which is what we've been doing so far, looking at individual strategies. Now you're going to be applying that information and putting it to use in the creation and maintenance and monitoring of a portfolio. And then you adjust and you roll based on the delta and the time to expiration. And for premium buying, for example, your profit target could be 100% of the debit that you paid. So if you buy a call for $3, you want to sell it at $6 so that you make $3 as well. It doesn't matter. I'm not so concerned about what type of guidelines you apply, what type of rules, but you have to have rules. Otherwise, you're going to be basically going without flying without instruments or going blindly. You're not going to have a roadmap as to what to do when this happens and this happens, and then you're going to have to make it up as you go, which is a sure recipe for disaster. Okay, so think of a having or building a portfolio and managing a portfolio think of it as something like if you're a woodworker, if you want to build a table, for example, you have the wood and you have your toolbox and you have the nails and you have the hammer and you have the pliers and you have the wrench and you have all the different tools that you need to build that table. All the different tools are your individual option trades, and your table is going to be your actual portfolio. You have to if those tools are defective, then the table is not going to be as good. Same thing here. If your knowledge and your experience of individual option positions is deficient, then you're not going to be able to put on efficient or effective positions such that your portfolio is going to suffer in the end. Here, the main objective is to have a portfolio that actually helps you achieve your objective. Your objective might be, you know what, I want to get at least 10% return at the end of the year, or I want to beat the S&P by 5 percentage points. It doesn't matter what you want. What's important is that all your individual components work towards the same objective. Adjustments and rolls. Those are modification to your original position. So you open up a position, you open up an options position, you sell a call, sell a put, sell a spread, put on an iron condor, you sell, you buy a strangle, put on a ratio spread. Doesn't matter what you do. Things change after you put it on, and sometimes it's in your best interest to modify it in a certain specific way. It could be adjust the strikes. It could be rolling to a next month. It could be adding to the same position without using any additional buying power reduction. It doesn't matter. Adjustments and rolls are any change that you have to make on your original positions. You need to keep track of all the adjustments and rolls for a trade, credits and debits, because your platform will not do this. So for example, if you sell a put in, let's say, April, and then you start making money or losing money, it doesn't matter, but you decide to roll that position and to keep the same trade in May, then what you want to do is you roll the April put, the April short put, to May. And in May, now you're going to have a short put, and it's basically the same trade, you just rolled it. So conceptually, you would keep it as part of the same trade. It's a different position now, because now the position is a short a put in May, but the trade is exactly the same. It's shorting a put. It's a bullish stance on that underlying. If you just take a look at your platform, you will not see the April component, because this is going to roll off. You're not going to see it in your platform. So if you had some profit in your initial component and you only look at the second part, the one that's still alive in your platform, you're going to have distorted numbers. So what you need to do is, for every trade, if you intend to keep track of adjustments and rolls, you have to every time you make a modification, you have to keep track of those debits and credits separately, because your platform won't do that. It's only gonna show you if you have components that are still alive, that are still active. So the suggestion here is to keep track of all the adjustments and rolls in a spreadsheet, so that you always know which equivalent position you have on, regardless of what you see in your platform. So let's say, for example, that you sell there's a stock trading at $100 and you sell the 90 put for $3, okay? And then you roll to the next month and you go from month 1 to month 2, and you close the original for $2 and you open the new one for another $3. So now if you look at your platform, you're going to see a position where you open it for a credit of $3. But that $1 that you made in profit from the original component it's nowhere to be found if you look at your monitoring page. So you have to keep track of that dollar that you had. And we talked about this when we talked about adjusting and rolling options positions, which is another lesson. I suggest you take a look if you haven't already. I talk about this, how to keep track of different debits and credits, and also finding your equivalent position. So for example, in that example that I'm mentioning, the equivalent position for the second month would be short the 90 put, but not for $3. You have to add the $1 that you already got. So the equivalent position is short the 90 put for the second month for $4, even though in the platform you're only going to see $3. You need to know what your equivalent position, your whole cumulative position is, so that you can make the best decision in terms of rolling, adjusting, or finally closing a position. If you want to wait until you have some profit, you have to consider all the different credits and debits that have been active or that have happened to that particular trade. Next one's beta weighted delta. So we talked about beta weighted delta, which is normalizing all the deltas of your positions. You can't, if you're talking about the same underlying, you can add up all the different deltas. But if you talk about different underlyings, you have to beta weight them such that you have an equivalent delta for your whole portfolio based on a single instrument. Usually we use SPY. So once you have this number and you have a delta number for your whole portfolio, so it doesn't matter what you have underneath, your whole portfolio has an equivalent SPY position, SPY delta, so beta weighted delta. So that means that it is as if you had those shares short or long in terms of SPY, and that's going to give you your directional risk or your directional component. Once you have that information, it's important for you to monitor that number such that you know whether your portfolio is too long or too short, or if you want to keep it neutral, you have to add positions, take positions off, etc. That's monitoring and managing your portfolio. That's what it means. You have to look at your directional component to your whole portfolio. So such that if needed, you can balance your portfolio deltas with shares of SPY. So for example, if you have a portfolio, and I don't care what you have 20 positions underneath, or you have, 100 trades, it doesn't matter. It doesn't matter how many underlyings, it doesn't matter. I want to take a look at a single number that tells me my exposure in terms of directional, the directional component. If I have a portfolio and it has 0 beta weighted deltas, that means it's neutral. So it's going to make money or lose money based on something else. It's going to make money or lose money based on implied volatility, based on gamma, based on the actual movement of the individual components. Maybe the ones that I am long are going to outperform the ones that I'm short, and then I'm going to be making money. This is a number that is extremely important. This is what's going to tell you whether you're long the market or short the market. And based on this, you're going to have to be doing some balancing. And a good portfolio manager, what he or she does is always tries to monitor all the time those numbers. Beta weighted delta is probably the most important one, because that way you know your exposure. And for an options portfolio, the main exposure, the main risk is delta. So if you have negative deltas and the market keeps going up, then you're going to be losing money. It doesn't matter whether your outlook for implied volatility was correct. Your delta is going to kill you. So that's what's important about beta weighted delta. So basically you have a portfolio and you have a number. So let's say, for example, I have a portfolio and I have 500 beta weighted deltas. That means that if tomorrow the market moves higher by the SPY moves higher by $1, my portfolio should be making $500, because that's the exposure that it has to the direction of the market. Okay, the suggested guideline is and bear with me here because it might be difficult to understand here, is between minus 0.5% and plus 0.5% of net lick. So if you have your whole capital, okay, your whole net lick, and you take minus 0.5% and plus 0.5%, those should be your limits as to how much delta you should have. You should never be exposed too much to one side, because if it moves on the other side, then you're going to lose a lot of money. So you have to keep a semblance of a neutral portfolio. So kind of like act pretty much like a hedge fund. You have to have some positions that are bullish, some positions that are bearish, some positions that are banking on IV contraction, some positions that are banking on IV expansion, etc. So if you have, for example, let's say a real number, let's say I have a portfolio that is $100,000, okay, 100K. The numbers that I want to see in my portfolio are anywhere between minus 500 deltas and 500 deltas positive. Okay, so if I open my portfolio and I set it to 0, it moves and fluctuates based on market movement, and then it goes to minus 500. I'm still okay, but that I'm on the higher range. We have to take action when those numbers are exceeded, such that you never let your deltas go beyond minus 1% and plus 1%. Under no circumstances should you have a portfolio that's so heavily weighted toward a directional move. If you just want to bank on direction, you might as well just go and buy shares or sell shares short, right? So we use options because we want to benefit from from how strategic those positions are, and we want to benefit from our implied volatility outlook as well, and from theta. We wanna put time decay to work in our favor. Okay, so you should take action when those numbers are exceeded. So between minus 5 and plus 0.5%, and it should never be beyond minus 1% and 1%. So if you have, again, a portfolio that's $100K, $100,000, you shouldn't have a portfolio that has a beta weighted delta of either less than minus 1,000 or more than plus 1,000. That would be too much, because actually that would be, if you think about it, the SPY is currently trading at around $320. If you have 1,000 deltas, what that means is that you have $320,000 worth of exposure, because it 320 times 1,000. So since you have a portfolio that's only 100K, you are leveraged way beyond your notional capacity. So you have a leveraging ratio of 3.2 times. Okay, so because of this, it's suggested that you never exceed 1%. And again, these are our suggestions. You can do whatever you want, of course. But if you want to think about being a more professional and a more somewhat less emotional and more analytical approach to managing a portfolio, you want to think about these numbers and making sure you never exceed those, or if you do exceed them, that you have a good reason for it. Next one is Porfolio Theta. Porfolio Theta, of course, all the different thetas of your whole portfolio added up. Those ones, because those are dollars per day, they don't depend on underlying. You can just add them up. You don't need to do any beta transformation. It's the total theta for all your positions. Now, we know that we have a beta weighted delta. So delta theta ratio should be as low a number as possible. Keeping it to an absolute value lower than 5 is a good practice to limit directional exposure. So if you have, for example, in our previous example, a portfolio that's 100,000, and you have $1,000 in beta weighted delta, so 1,000 beta weighted deltas, and you have a theta of $200 per day, then the delta theta ratio is going to be 5, which means that you are exposed too much to price movement, and you're not benefiting too much from the theta or the time decay. So the suggested guideline is to aim for a portfolio theta of between 0.2% and 0.5%. So if you have a portfolio that's 100,000, we'd be talking about anywhere between $200 and $500 in daily time decay in your favor. Remember that theta is a daily value, so you can calculate your annual theta. So if you make 0.2% or 0.5% a day, how much are you going to make a year if you manage to maintain those numbers for the whole year? 0.2% times 365 is around 73%. 0.5% times 365 is 182.5%. Now, those numbers mean that you put on your position and everything that you want to expire worthless does, and every position goes your way. It doesn't happen that way. But if you're a good options trader, you should be able to keep between 20 and 25% of your total theta as profit. So assuming you keep 25% of your portfolio theta, you would make that 73% converted to real numbers would be a return of around 18%. And if you keep 0.5%, then you would make around 45% a year, which are pretty good numbers. Now, this number is based on experience, and it's based on, balancing your deltas and applying best practices, etc. So from the theta number that you get, if you think that you're going to keep 20 to 25%, that would be a good indication of what you're shooting for. Remember, when you sell premium, you are not going to have a position that grows and grows and grows and makes you more and more money every time, because the max profit is capped if you're selling premium. If you're buying premium, then yes, your profits could grow exponentially, but at the same time, if nothing happens, time decay is going to start hurting you. So far we have for delta anywhere between minus 0.5% and plus 0.5%, but with absolute values not exceeding 1%, negative or positive. And for theta, anywhere between 0.2 and 0.5. Anywhere below 0.2, you're not going to make a lot of money, and you're going to go for returns that are very close to what the normal market gives you. So why go through the whole process of managing an options portfolio if you can just buy the spiders or NASDAQ or whatever it is that you feel is going to go up during the year? So theta between 0.2% and 0.5%. Beta weighted Vega, now you have Vega for individual positions, the equivalent Vega for your whole portfolio based on a single instrument, usually the spiders. So you have to monitor both your portfolio Vega and your position Vega. Now, how do you get your portfolio Vega? You multiply your raw Vegas, so the Vegas of every position, of every underlying, by the beta coefficient, and you add up all your positions. So when you have the beta is an indication of how much more volatile your instrument is compared to the market, and the market is number 1. So if you have a beta of 2, your instrument is twice as volatile as the market. So you convert your raw Vegas to portfolio Vegas, and you add them up, and you get your whole exposure. Now, if you're selling premium, you're going to be negative Vega. So implied volatility expanding is going to hurt you. How much? Well, a guideline could be that your Vega exposure can be hedged with VIX, knowing the approximate equivalence of every 1% of SPX that goes down is going to be approximately 10% of VIX. So not 10 points, but 10%. So if SPX is trading at 320, and if it goes down by 32 points, you should see any VIX going up by around 10%. So if VIX was 20, it's going to go to 22, something like that. So if you know that you have an exposure based on Vega, you have to, if you want to maintain a hedge such that you're not surprised by a sudden expansion of IV, which is what happens in a crash, then you could hedge your position with VIX. Okay. Now, what VIX product? That's another whole lesson, because the VIX is not a straightforward instrument. VIX is an index. You can't buy it. You would have to buy VIX options, or sell them rather, put on a VIX position, or use VX futures, or also some of the ETFs which have their own set of problems or challenges, shall we say. So we should be aware of using an adjustment for your raw Vegas if your portfolio has products with different expirations, or if your expirations are too different from VIX. VIX is an annualized number measuring the expected volatility of SPX for the next 30 days. If your portfolio is 60 days, then that volatility, those moves are going to be tempered. They're going to be less than the moves for the volatility in the 30-day tenor. Because of this, you have to adjust your raw Vegas, which is another option, another lesson in itself. And I've already covered this in the lesson where I talk about the truth about calendar spreads and raw Vega. So if you want to check it out, you can check it out. It's basically just be aware of your positions, which expirations they have, and whether they're very different among themselves, and also if they're very different than the 30 days that VIX uses. Now, extrinsic value is the option value that's dependent on volatility and time to expiration, as opposed to intrinsic value, which is only dependent on stock versus the strike price. So extrinsic value is the additional extra portion of an options value that happens because of the time to expiration and the volatility, which means this is the value that goes away when those options expire. Premium sellers will benefit from time passing and eroding extrinsic value. And the suggested guideline here is to monitor extrinsic value to determine what would happen to your positions if they expired today, which means that all extrinsic would go to zero and then adjust as necessary. So if you have a position, for example, that's making, let's say, I'm just going to throw out a number, that's making $100, and you see that you have $20 remaining as extrinsic to come out of the position. So if the extrinsic value goes away and they expire, you would have an additional $20. So you're making 100. Your best case scenario is going to be 120, and you still have a month to go, let's say. Why would you keep that position that's going to give you only 20% more, and you have still 1 month to go? Then what would happen? Then at that point, you would have to make an assessment and say, okay, the 30 days that I'm going to take in risk are not worth the remaining extrinsic value that's going to come out of the position. So at that point, a premium seller would say, I'm going to close it. I'm going to take my $100. I'm not going to wait for the additional 20, and I'm going to eliminate my risk. Because if you keep it on, keep in mind that right now the price is favorable to you, but who's telling you that the price is not going to turn against you? And then you would have a problem in your hands. So extrinsic value is very important to measure and to monitor, because it gives you it gives you an idea, and it gives you a sense of the money that still remains to be made if it's basically assuming that everything goes to zero, so that the option expires right now. If you're in the money, that it expires at that level, and if you're out of the money, that it expires out of the money. Same for premium buyers. If you buy a call, if you buy a put, if you buy a strangle, if you buy a straddle, something like that, if you buy a back spread, if you do any of that, then time passing is going to work against you. And if you look at your extrinsic value, that number is the one that you're going to have to subtract from the position that you have right now. So if there's an underlying that's trading at $100 and you buy the $100 call, for example, for $5, okay, and it stays at the $100 in underlying price, but now it has $3 only, so it's trading at $3, you're losing $2. You look at extrinsic value, your whole $3 is extrinsic value, which means that if we fast forward in time, and if we assume that the stock expires right here, or the options expire right here with this underlying price, then you would lose everything. So knowing this is going to allow you to make a determination whether you want to roll, you want to adjust, you want to take them off, etc. And again, you have trade management principles or trade management guidelines, which are going to guide every component of your portfolio. But your whole extrinsic value in your whole portfolio is also going to tell you whether you need to take action on some individual components. Finally, correlation is how similarly different instruments move. If they all move together and you're long all of them, you might as well be long one of them in size, right? So what you want correlation working in your favor, so that even if some underlyings move against you, you have some that benefit from that move. Okay. So what you want to do is you want to use non-correlated underlyings and diversifying products strategy in time to expiration. We mentioned this. We need to diversify, not only not use one single underlying, use several underlyings. Not only that, use different underlyings in different sectors. And furthermore, diversifying products. Not only should you use tech companies and mining companies, but you should also use some instruments that are not companies, maybe foreign exchange product that has options, or bonds, or gold, or oil, something that's not related, okay? And then diversify the strategy so that you're not only waiting for IV contraction, for example, because what happens if IV expands? Then all of your positions are going to suffer. So you want to have a diversification in strategy as well, and time to expiration, because what happens if IV expands, but only for the very short term volatilities and not to the longer ones? Okay, so you want to have a diversified portfolio such that it's resilient and it's not going to fluctuate a lot. It's not going to all of a sudden give you a lot of losses. Maybe you're going to sacrifice a bit of profit if you had been on the right side of a directional move, but by the same token, you are contributing to bring your results volatility, the volatility of your results, the volatility of your returns. You want those returns not to have a lot of volatility. You want them to be pretty constant and giving you the money that you want to make based on the objective of your whole portfolio. The suggested guideline is to look for as many underlyings as possible that have as close to zero correlation among them. When there is a very low degree of correlation among your underlyings, so a high degree of independence, your real numbers will work out to be very close to the numbers predicted by the probabilities of the individual trades. If we only put on trades that have a high probability, those probabilities are going to manifest themselves. They're going to work out if we have a sufficient number of uncorrelated instances in our portfolio. So now we're going to take a look at a real example of an options portfolio, and we're going to see how the capital that we have we can start using to put on trades, and how we're going to allocate the capital based on favorable market conditions or unfavorable market conditions. Remember, for premium sellers, so those conditions, favorable and unfavorable market conditions, are dependent on what you consider those conditions are. So for example, for premium sellers, basically what we're looking for is high levels of implied volatility. So if we have low levels of implied volatility and the number is very low, we're going to lean towards the low end of the range in terms of capital allocation. Whereas if we have an elevated level of implied volatility, we're going to lean towards the higher end of the range. So in this case, between 20 and 50%, of course. So if we have a total capital of 40,000 and we have those 40,000, we're going to divide them between cash and trading capital. So if we have low IV, so unfavorable market conditions, we're going to allocate only $8,000 to trading, and 32 we're going to keep in cash. And if those conditions are favorable, then we're going to allocate half and half. So 20,000 to trades and 20,000 to cash. Now, of course, the favorable and unfavorable market conditions, those designations are dependent on the individual trader. For example, if you only like to do bullish trades, bullish option trades, and stocks have very elevated prices now, so there's not a lot of opportunity right now in the market, then you would consider that to be an unfavorable condition or unfavorable market conditions. Then you would lean towards the lower end of the range. Again, it's dependent on the trader that makes that determination. So now we know this number is going to fluctuate between 8 and 20,000. So for low IV, we're going to have 8,000, and they're going to be assigned to defined and undefined risk trades. So remember, we talked about a 25-75 split between defined and undefined. So we have 2,000 assigned to defined risk trades and 6,000 assigned to undefined risk trades. If we have a high IV, those numbers grow, of course, because we have now more capital, but the split, the proportion is the same, 25-75. So we would put $5,000 to defined risk trades and $15,000 to undefined risk trades. Okay, and we're going to keep 20,000 in cash. So this is a visual representation, of course. It's just a pie chart here. So if it's a low IV environment, this is cash, this is defined risk, and this is undefined risk. If it's a high IV environment, so for premium sellers, a favorable market condition, then we're going to keep 50% in cash, 20,000, and we're going to allocate 5,000 to defined risk and 15,000 to undefined risk. So you can see more or less how your portfolio is being used. So see how this way of looking at your portfolio is a more professional way of looking at your portfolio. We're not talking about whether you're going to sell puts in Microsoft or sell a straddle in Google, or we're going to buy Tesla or anything like that. We're looking at your portfolio. You're going to see how the individual components of your portfolio give you the profits that you want, but you have to have a bird's eye view of what you want to achieve and how you want to achieve it. Okay? Now we're going to move on to trade allocation guidelines. Remember, we talked about defined risk and undefined risk, how for defined, it was anywhere between 1 and 2% per trade. And for undefined, it was anywhere between 3 and 5% per trade. Our total capital is $40,000. So 2% of 40,000, every defined risk trade is going to be approximately $800. We're going to allocate $800. And every undefined risk trade is going to be allocated a 5% of total capital. So it's going to be allocated around 2,000. Again, these numbers are not going to be exact. They're not going to be, down to the cent exactly what we're going to assign, but it's a good number to shoot for when we're trying to put on those trades. So for example, now that we know how much we're going to assign to every trade, and we know how much we're going to assign to every type of trade here, we can figure out how many trades we're going to have on at one single time. So if we have a low IV environment, so unfavorable market conditions, we're deploying 20% of our capital, and we're using 15% to undefined and 5% to defined risk trades. Okay, so we could assign 2 defined risk trades and 3 undefined risk trades. So we can have, for example, here a short call spread and a short put spread. And undefined, we can have a strangle, and we can have a short call and a short put. And that's it. That's our portfolio. And then we are going to apply our rules to take the trades off based on whether we want to adjust them, we want to roll them, we want to take them off, we want to close them. So, but now we have a bird's eye view of your whole portfolio. And the same thing for a high IV environment. We would have a total of 6 defined risk trades because every trade is $800. So we can deploy $5,000. So 6 times 8 is 48. So $4,800. So 6 defined risk trades and 7 undefined risk trades because we can use $15,000 and each one of them is 2,000. So it's roughly 7 positions. Okay. Now, like I said, it's not exact. We could have 6 and 7. We could have 7 and 7. We could have 5 and 8. It doesn't matter. You have a good idea of how to deploy your capital in a different trades, and you can get good diversification with 5 trades or with 13 trades. Of course, you can have better diversification, but you can apply those principles with this type of portfolio allocation. Okay. Next, we have portfolio metrics, what we talked about. So daily theta is going to be anywhere from 0.2% to 0.5%, and beta weighted delta is going to be anywhere from minus 0.5% to 0.5%. Okay. This is what we talked about just now. Okay. So we are going to be aiming for a daily theta number anywhere between 80 theta, because we have a total portfolio that's 40,000. So 0.20% would be 80 thetas, and 0.50% is going to be 200 thetas, right? 0.5% of 40,000. Okay, so your portfolio should have anywhere from 80 thetas to 200 thetas. And for directional exposure, you want to keep them less than the range between minus 200, which is minus 0.5% times 40,000. So anywhere from minus 200 beta weighted deltas to plus 200 beta weighted deltas. So now you look at all your positions and you see whether you have enough theta, enough the beta weighted delta, and now you have a portfolio exposure. Now this is what we talked about, the annual return benchmark. The annual return is expected to be around 25% of the annual theta. So if we use 80 thetas or 200, we have in the whole year 29,000 and 73,000. So total return would be 25% of that. So those thetas are converted into 1/4 of that number in dollars. Same here. And you would have a return of anywhere between 18% and 45%. Now, of course, these numbers are not set in stone. You have to manage your positions. You have to have some market move your way, or at least you have to have the market not go exactly against you all the time. But yeah, those are numbers that you can pretty much rely on in terms of the return that you're going to get by applying or by building and designing, implementing, and monitoring and managing a portfolio like this. So this is how you put together a portfolio. This is the way, more or less, the way the pros do it. This is the way we do it. And It's worked out well for us over the years. Having good diversification helps a lot because sometimes some things are not working, but some other ones are working. So you take those off. Maybe they gave you the profits that you wanted, and then later on, the ones that were not working before now start working. And at that point, you know that you can start taking those off as well. And you have to get used to the fact that options expire. So you have to be very comfortable taking positions off and putting positions on. It's a constant process because you have to turn your whole portfolio over at a certain point because those options expire. They can't stay there forever. This is not like a stock portfolio where you buy the stocks and then you set it and forget it. Okay, so you have to consider your portfolio a living entity that needs constant replenishing of trades. And how many you need is based on how many come off, how many roll off, how many drop off. And with that information, you know how to maintain the proper allocation based on the environment and based on the conditions that the markets call for. Okay, so this is more or less how you would have your portfolio, and this is the way to now every trade you have to apply the principles that we've looked at over the last few months, which is how to make money, your deltas, etc. for every individual trade. Those are going to work the way they are supposed to work, and if you know their mechanics and if you know their pricing and you have a standard methodology to manage them, then they're going to give you whatever it is that you are aiming for. Especially if you diversify it. I can't mention it enough. Diversification is very important. It's key when you keep a healthy portfolio, because the main reason why portfolios fail, number one is trade too big, but number two is you're trading the same thing with different underlyings, and in that case you don't have real diversification. You only have different instances of the same trade. So this is how you would put it together. Now you have to work on your own portfolio and see how you will design and how you would implement such a portfolio. But this is more or less how this works, and this is a constant cycle. You always have to be looking for trades. You have to always be looking for indications in the market, whether the market is turning from a low IV environment to a high IV environment, or whether the prices are more tempting right now to put on bullish positions or bearish positions or what have you. It depends on you as a trader. That's where the creativity portion comes in. But the most important thing is now you know how those numbers work, and now you know how to put together a whole portfolio, and you're going to be way ahead of most option traders that do it just on an ad hoc basis, or with no guidelines and no order and no structure at all. I hope that this lesson gave you some information that you can use and apply to your own trading, and I hope that you can start designing and implementing your portfolio. Feel free to contact me for any questions you might have about this, and goodbye.